Telclip Ltd's right to substitute any asset when it malfunctions doesn't preclude Vodacare Ltd from having the right to use the assets, which are explicitly specified in the contract. Vodacare Ltd did not design the network in a way that predetermines how and for what purpose the assets will be used throughout the period of use, but can direct the usage of the network throughout the period of use. Vodacare Ltd will also obtain all of the economic benefits from the use of the assets throughout the period of use. The main reason why options 1, 2, and 4 are incorrect is due to incomplete and inaccurate analysis of the lease criteria. For instance, option 2 mentions the assets are explicitly specified and Vodacare Ltd has the right to economic benefits, but doesn't stipulate the reasoning that suggests that the critical aspect is not just the explicit specification but also the lack of substantive substitution rights by Telclip Ltd and Vodacare's control over the assets use. Thank you.
The correct accounting treatment is option number 2. It's correct because Vodacare elected the IFRS 16.15 practical expanded, which allows them to treat the lease and related services like maintenance as one lease component if the assets are highly interrelated, which are cell phones, control boards. The other options are incorrect because why are the other options incorrect? Option 1, wrong method was used. It's used asset cost instead of lease payment. Option 3 ignores the practical expanded. Vodacare doesn't have two separate components. Option 4, low value exemption doesn't apply. Total assets value is not low.
The contract between Aramex and Movit Ltd contains a lease because the trucks are already identified as assets, and the conditions of the right to control are met as per paragraph B9. And Aramex have the right to obtain substantially all the economic benefits of the trucks, which are the identified assets, and the right to direct the use of the identified assets, which are the trucks, and the right to direct the use of those trucks are for both years, and which means option 1 is the correct answer, and option 2, 3, and 4 are incorrect because they don't address the right to direct the use of the asset, which is for both years, and they only consider a lease on the first day of the contract.
Why option 2 was the correct answer. Aramex Limited will account for each lease component separately based on the standalone selling prices of each lease component. The maintenance contracts will be accounted for one of its non-lease components, and the consideration will be allocated to this component and will amount to an amount of 29,492 Rand. According to IFRS 16, in determining the correct answer for question 4 was IFRS 1612 states that the contract contains a lease of one component or more or additional non-components. Therefore, a lease must be allocated in the consideration of the contract to each of the leases. IFRS 16b33 says leases must be used to observe standalone selling prices if available to estimate them if they were not provided. IFRS 16b34 speaks on the maintenance services and generally the non-lease components and should be separated if practicable. Upon analyzing these incorrect options for question 4, we found that option 1 was not correct since it contradicts with IFRS 16.12 paragraph 12, as it states that leases must be allocated for both leases and non-lease components, but they must use a workable solution in terms of IFRS 16 paragraph 15, which Aramex did not do so. It also ignores the non-leases maintenance components as a whole. There's also a common error where they are assuming that only lease components are relevant for accounting under the IFRS 16 standards. Why option 3 was not correct? It mixes the lease and non-lease components based on the 18,000 and the 12,000 for the maintenance, which must be together, which is prohibited in IFRS 16 and must, but provided that they are applying a workable solution to it. There's also a common misunderstanding on the treating of the lease and the maintaining cost as the single combined lease cost. Why option 4 was incorrect? It is because They separated the components and failed to calculate the consideration properly using the relevant selling prices. Option 4. It is because they separated the components, assuming that the non-leases components are exactly 30,000 but correctly accounted into 29,000, but not correctly accounting into 29,492 based on the proportion calculation. There's also misleading due to the ignorance of IFRS 12 requirements relating to the calculating of the absolute figures.
Question 5. To calculate the interest rate that is implicit in the list of the merchant at initial recognition, of which is 1 July 2020, the data collected as follows. Payment is 30,736, present value is 95,000, future value is 20,000, but according to the applicable standards, net realizable value is included in the future value, which is 5,000, and then 5,000 will be included in 20,000, which will make 25,000, and the number of years initially at the beginning of the year will be 3 years. And if you put all that information in the financial calculator, the applicable interest that will be used as 10.12%. Thank you.
On calculating the lease liability of GOGO Ltd, in terms of IFRS 16 paragraph 26, the lease liability of initial recognition shall be measured at the present value of the lease payments that are not paid at that date. The lease payments shall be discounted using the interest rate implicit in the lease. The present value of the lease is calculated using the financial calculator as follows. The number of years N is 3 years, which is lease period, which our value is 20,000, which is a specified final payment of the contracts. Annual lease payment is 30,736. The interest implicit is 9%. This gives us present value of 93,246, less legal fees of 5,500, which gives us the lease liability of 87,746 on initial recognition.
The initial cost of the right of use of assets is calculated using paragraph 24 of IFRS 16 and is calculated as follows. First of all, we have to account for the initial measurement of the lease liability, which was given as 92,000, and the lease payment made before the commencement date or on the commencement date, and less the incentives that were received. The initial lease payment was 30,000, and the incentive that was received was 6,000, which is calculated by the 10,000 of the legal fees times the 60% of the reimbursement. And thirdly is the initial direct cost incurred by the lessee, which was 10,000 of the legal fees that were given on this scenario. And the estimated future dismantling cost were also given, which is 11,500. Then when you add up all those amounts, that will amount to 137,500, which means the correct answer is option B. Option 1, 3 and 4 is incorrect because it does not comply with the requirements of paragraph 24 of IFRS 16.
To calculate the gross investment in the finance lease for Home Ltd, we consider the total lease payments receivable. Calculation of gross investment. The gross investment includes lease payments for 3 years, which is 30,736 multiplied by 3, equal to 92,208. Number 2, final payment, which is 20,000. Total gross investment is equal to this payment, 92,202 rand, plus final payment, 20,000, would give us 112,208 rand. Why option 3 could be correct? If we strictly follow the calculation without additional assumptions, the lease payment over 3 years plus the final payments give us 112,208 rand. This, if option 3, 111 rand, 208 rand is stated as correct, there must be a specific detail or adjustment we are missing that reduces the total by 1,000 rand, which is not directly apparent from the calculation provided. Why option 1, 2, and 3. Why option 1, 2, and 4 must be not correctly based on calculation. Option 1, 92 rand, 208 rand seems to be on account for lease payment without the final payment. Option 2, 117 rand, 208 rand might include additional payment or assumption not directly supported. Option 4, 112 rand, 208 rand matches the calculation based on lease payment and final payment. Given the calculation direct supports 112 rand, 208 rand, and without further details on why 111 rand, 208 rand would be correct figured based on standard calculation we follow the calculation logic provided. If there is an adjustment or specific reason, 111 rand, 208 rand is correctly not directly related to the calculation provided. It will need the further clarification.
On the unguaranteed residual value of 5,000 that was revised to 4,000 rand, the correct journal entry that should be passed by Vegeta is to debit finance income and credit unearned finance income and gross investment in finance fees. Debiting unearned finance income and credit gross investment in finance this journal entry is incorrect. This is because this entry ignores the impact of finance income in profit or loss. IFRS 16 paragraph 53b requires that LEC discloses the finance cost for the reporting period. Finance costs are accounted for in the statement of profit or loss. Debiting gross investment and crediting unearned finance income is incorrect. This is because this entry is incorrect since it increases the gross investment. Gross investment should be decreased when the unguaranteed residual value decreases. This entry implies that you are adding a future cash flow, which is not correct in this case. IFRS 16 paragraph 7 requires payment. IFRS 16 paragraph 7, the lease payments included in the investment of the lease include any residual value guarantees. And lastly, debiting gross investment and crediting finance lease and unearned finance income is incorrect. This journal entry is incorrect because it increases the gross investment. As a result of the residual value, the gross investment should rather decrease to appropriately account for the residual value.
GoCo Limited will process the following journals on 1 July 2021 after the reassessment of the lease. Firstly, we will have to calculate the present value using the financial calculator. The data collected will be the number of years will be 4 years, future value 20,000 that is negative, payments will be 30,736, and then the interest will be 11%. If you use the financial calculator to calculate the present value, that will give us the amount of 108,531. To process the possible journals, we will say debit the rights of use of an asset, that is the lease machine, SFP, credit the lease liability, SFP, and then the total amount will be 108,531 minus the 70,900, that will give us 37,631. Why other options are incorrect? Under IFRS 16, lease assessment requires adjusting the lease liability and rights of use assets by the present value of revised lease payments using the appropriate discount rates. Option 1 is too low, suggesting an immaterial change not consistent with the reassessment criteria. Option 3 and 4 overstates the adjustment, likely exceeding the realistic impact of the lease modification. Only option 2 reflects the reasonable, properly calculated adjustment aligned with the standards.